Oliver, sterling has reached $1.70 almost. My US dollar exposure is screaming out in pain. But if the UK economy is taking off, I wonder if now isn't the time to buy shares in Lloyds Bank.
A lot of people have been. It's been a very popular stock over the past year or so. And today's first quarter results show perhaps why that's the case. That recovery in the UK is starting to show through in some of the underlying numbers. Loan volumes are increasing, albeit slowly in some cases. The net interest margin is rising, which is always a good sign of recovery for a bank. That's partly due to refinancing earlier this year. And impairments are falling. There's quite a sharp fall in the first quarter impairments. So all of those things moving in the right direction, suggesting that this UK economy is finally showing through for the bank. The problem is whether that's actually getting through to shareholders, though.
Okay, well, what should shareholders look out for? I mean, what's the noise here they should be wary of?
As ever with banks, there's a lot of noise and there's a lot of things between the underlying profits and what shareholders can get into their own pockets. What there isn't this time around is another provision for PPI mis-selling claims. There's not that, but there are other exceptional charges which eat things up. The TSB unit that's going to be floated off this summer, that's still taking up charges. There's still restructuring charges to come. There's various other bits of noise. So further down, there's still things that are preventing shareholders from feeling the full benefit of the underlying improvement.
Okay, so I'd be aware that I was buying a bank, but a UK-focused bank still sounds, relatively decent. But what does valuation look like here?
Well, the valuation still looks pretty high. The shares, they're up about 5% this morning, and they before that they'd fallen a tenth this year. So people have been taking a bit of profits in this. But even after all that, it still looks pretty expensive. On a book value basis, it's on 1.4 times tangible book value. That's very high. Most European banks are on either in line with book value or 1.1, 1.2. Even Standard Chartered, with all its emerging markets exposure, is worth much less than that. It's not so expensive on a PE basis, and some people say that now that's a more relevant metric to look at banks on as earnings start to grow. So Lloyd's not so expensive there, but still on a price-to-book basis, the shares are looking pretty pricey.
Okay, so maybe not a sterling investment just yet. Thank you, Oliver.